question of liquidity. So one of the most crucial functions of the money market is to maintain liquidity in the economy. Some of the money market instruments are an important part of the monetary policy framework. RBI uses these short-term securities to get liquidity in the market within the required range. Okay, so especially if you look at this players of money market or major participants. So look at commercial bank. If you know the commercial banks where most of us, the general public, are depositing our money in with a trust factor. Okay, so imagine a situation if this particular commercial banks are going very low on liquidity, that they're running out of cash. So what will happen if tomorrow you go to the ATM, try to withdraw money from your account, and you learn that you get a message that this particular bank is now having a liquidity crunch, so we cannot pay you your money for some time, indefinitely. We do not know when there will be cash with us, extra cash with us. So that is going to be a very big crisis that will hit us. Okay, not good at all. So you see, this is just one small example that I'm telling you. There may be so many other sectors which may be facing equally important liquidity gaps. And to fill up that gaps, the best option are money market instruments. Because you see, if you go to the capital market to fund your liquidity crunch, then you see most of the investments in the capital market are for a longer, comparatively longer duration. So that might leave you with more further problems. Okay, so one of the most crucial functions of money market, or reason why we even have a money market, can be because we have to maintain adequate liquidity in the market. Okay, so you see that liquidity, the term liquidity, or the maintenance of liquidity works both ways. On one hand, if there is very less liquidity, there is a cash crunch with the bank, then they can go to the money market to get funds immediately, overnight. Or if there is very high liquidity in the market, that is also not good for the economy. If it is consistently high, then it is not good, because you see, this will increase the money supply. And we all know what happens when the money supply increases, inflation will increase. Okay, so too much inflation is not good. So which is why the RBI has to take steps so that the liquidity level of the market is optimum. It should not be very less, it should not be very high. Okay, so there are various techniques using which the central bank of a country controls the liquidity at a very optimum level. So we will also study what are the different techniques that are being used by RBI to control the liquidity level in the money market, of the market in general. So point number 2, provides funds at a very short notice. Okay, so you see, there is another thing, that if you need large amount of money at a very short notice, okay, if you go to any other market than the money market, maybe you will not get access to any such fund. Okay, highly unlikely. So money market offers an excellent opportunity to individuals, small and big corporations, banks, of borrowing money at a very short notice. These institutions can borrow money by selling money market instruments and finance their short-term needs. Okay, so if at times if your business is requiring a huge amount of money, but very quickly you need it, and you need it for a very short term. So in that case, you can easily go to the money market, look at the different options that you have, and look through a proper channel, you can draw funds from the money market. Third number, utilization of surplus funds. Money market makes it easier for investors to dispose of their surplus funds, retaining their liquid nature, and earn significant profits on the same. So you see, it's a win-win situation. You can dispose of your surplus funds. At the same time, you also retain your liquid nature, and also you earn significant profits. So you see, many a times organizations may be from time to time left with much extra amount of cash, the extra amount of fund. Okay, So you see this, funds, they cannot invest in long-term security because this will compromise their liquidity position, right? So a particular business may be having 10 or 20 lakhs, which they are not utilizing currently, but they may need it after 2 or 3 months. If they invest this particular 10 lakhs rupees for 2 months only in the capital market, they will make very less money, or they may not even find a suitable instrument that suits the requirement, and at the same time they can get the maturity period is over by 2 months. It may not be possible. So you see, instead of going to the capital market, they go to the money market. They can use this 10 lakh rupees, invest in the money market for 2 months, get it back exactly after 2 months, so that their liquidity is not compromised, and at the same time they are going to earn some kind of return on it. Okay, so obviously this return is going to be higher than keeping money in the bank as a savings account or as a fixed deposit. Right? Then it facilitates investors saving into investment channel, that is for the very short time. These investors include banks, non-financial corporations, as well as state and local governments. Point number four, aids in financial mobility. Money market helps in financial mobility by allowing easy transfer of funds from one sector to another. This ensures transparency in the system. High financial mobility is important for the overall growth of the economy by promoting industrial and commercial development. Okay, so you see, this is a particular you can say a particular event which you'll find in the capital market as well. So you see, this particular market, just like any other financial market, eases in flow of funds from between different organizations. Okay, so you see, suppose there is a commercial bank here. All right, the commercial bank has some extra money. Suppose this is say Axis Bank. Okay, so the Axis Bank has some extra money that that they have for say like 3 months. So they want to invest this. All right, so they will purchase some treasury bills from RBI. Okay, so they may be purchasing 91 days T-bills from the RBI. All right, now again, suppose they have paid this particular money to RBI, and RBI has issued them certificates. Now RBI is now having some 10 lakhs or something from Axis Bank in return for this certificate. Now on the other hand, you see there's another bank, say Standard Chartered Bank. Okay, Standard Chartered Bank is in need for short-term finance. For you see the coming 3 months, they are estimating, or they are forecasting that they may be having a liquidity crunch because they've invested huge amount of sum in a particular sector. So you see, they are afraid that they may be going into a liquidity crunch, and this may affect their reputation, or it may affect their overall financial health. So what Standard Chartered Bank can do is that they can issue or sell some kind of money market instrument to RBI. So RBI, whatever money fund they have got from Axis, they will further transfer it to Standard Chartered, okay, in return for a certificate, some kind of money market instrument that has been issued by Standard Chartered to RBI. Okay, so for that matter, you see the fund is being seamlessly flowing from Axis, who has extra fund, to RBI, who is in this situation is kind of a mediator, and from RBI it is going to Standard Chartered Bank, who is actually in need of money. Okay, or the transaction can directly take place from between these two banks. So anyways, this is how seamlessly funds are being transferred between various sectors in the money market. The last one helps in monetary policy. So a developed money market helps RBI in efficiently implementing monetary policies. Transactions in the money market affect short-term interest rate. Short-term interest rate gives an overview of the current monetary and banking state of the country. This further helps RBI in formulating the future monetary policy, deciding long-term interest rates, and a suitable banking policy. So you see, whatever is happening in the money market has a very important bearing on the short-term interest rate. Okay, short-term interest rate on the other hand has, in the long run, it has a bearing on how the long-term interest rates are fixed. Okay, and using the money market, using how the situation, how, you know, what is the interest rate, what is the current demand and supply in the money market, all of this very effectively influences the RBI, the central bank, in formulating the monetary policy. Okay, so how RBI is going to formulate a monetary policy or a banking policy, we will learn that in the subsequent topics. Okay, how exactly that is being done. Also, you see, in case of banking policy also, suppose I'll give you a hypothetical example. Suppose it is being noticed by central bank that all the banks are say having they are not maintaining adequate liquidity, or what the central bank has realized is that the money market in India is very efficient. Okay, so you see the CRR and SLR liquidity, which is always prescribed by the central bank, so that may be a bit higher than the average. Whatever other countries are having, whatever rates they are having, every country have their own specific rates. So India is keeping this particular two rates, CRR and SLR, at a bit higher than the average. And in with time, RBI has noticed that the money market in India is very efficient. So you see, the banks can always go to the money market to raise fund in case they are having shortage in maintaining CRR or SLR. So you see, if the bank is giving a too high percentage requirement of CRR or SLR to these commercial banks, this may hamper their investment activities, right? Because this money will be just lying around. They cannot invest this money anywhere. They are not getting any return on that, right? So as a result, if RBI feels, or if they have decided, or if they have learned that money market is very efficient, it will supply funds to these banks whenever it is required. So this may lead to RBI to decide that CRR and SLR rates may be decreased by some points. Okay, because you see, money market is efficient. So further, if we decrease this a bit, then their requirements will be lower, so they can invest some amount of this fund under various investment opportunities and earn higher returns. So profitability of the bank will improve. Okay, at the same time, if there is liquidity crunch, they can go to this very efficient money market that we are having. So in this way, the money market events also influence a lot on the monetary policy that is decided by the RBI, and at the same time framing a suitable banking policy also. Okay.